In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about how India's top cement giants are signaling what lies ahead for our country's construction and growth. And in the second story of the day, I'll talk about why the fall in global commodity prices is not the good news that it may look like and what it really means for our country, India. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 7th of May. The results of the two biggest cement companies of the country, which is UltraTech and Adani Cement, recently came out. Now, I know cement may seem like a boring product to most people who are watching this, but the thing is, for a country like India, cement is one of the best ways for us to understand how fast we are building and therefore how fast we are growing. I mean, think about it. Every road being laid, every flyover that is being built, every new apartment complex, or even a warehouse or a shopping mall, they all need cement, at least by today's construction standards. So basically, when cement companies report good numbers, it usually tells us that construction across our country is fairly active. And on the other hand, when they actually talk about things slowing down, it usually hints that projects may be on a pause. That could be because of weather, elections, or economic conditions. So while the story that I'm talking about might at first look like a simple earnings update, the truth actually is that it gives us a great and meaningful peek into what is happening in the real Indian economy. So with that basic context in place, let's first quickly zoom out and understand what the management of these two particular companies are saying about the sector itself before I get into the numbers. Starting with UltraTech, their management gave a fairly detailed picture of what they are seeing on the ground. They pointed out that infrastructure projects like road building and public works are going very strong in some states, especially Andhra Pradesh and Bihar. But at the same time, they also admitted that urban real estate has seen a fair bit of a slowdown. Fewer new housing projects are being launched in cities right now, but they don't think that will last very long. Their view is basically that it is a temporary dip and urban housing demand will start to pick up once again very quickly. One more interesting thing that they highlighted, which most people don't usually consider, is the impact of weather on this. See, the company said that the start of the financial year has been fairly weak because of the intense heat wave that we've all seen. And it also makes a lot of sense if you think about it. Basically, when temperatures go above, let's say, 40 degrees Celsius, it's nearly impossible for construction workers to keep working outdoors for long hours. It's unsafe, and concrete also cannot be poured in extreme heat. So work obviously slows down or even stops altogether in some cases. It's basically a seasonal low and one of those underappreciated ways in which climate directly affects business. But on the other hand, Adani Cement, which by the way for your context owns Ambuja and ACC Cement, is a little more upbeat about all of this. They said that cement consumption grew by nearly 7% in the March quarter and might go even higher in the next year. In their view, the industry is fairly well positioned for strong demand in FY 2026. They are basically betting on things improving quite a bit once we get past the peak summer and also move into cooler months when construction becomes a little more active once again.
The cement consumption grew almost 6.5 to 7% in Q4, and we are expecting that it will have a continued improvement and reach say 8% overall demand growth for FY26. Therefore, the prospects of the industry definitely looks better, and to me, FY26 should be far better than FY25.
So overall speaking, both companies believe that demand is intact. There may be short-term disruptions because of heat, but there is no sign of a very serious slowdown as such. And if at all there is anything, the second half of the year might actually look much stronger than the first half. Anyway, let's now move on and talk about how each of these companies actually performed on paper. Let's start with UltraTech. Now, this is the country's largest cement player and it is a part of the Aditya Birla Group. Now, for your context, UltraTech Cement over the last year or so has been in a major expansion mode. They acquired India Cements and also Kesoram, and thanks to both of these, they now have the capacity to produce 184 million tons of cement annually. Now, that is massive. In fact, just in the past year, 57% of all new cement capacity that was added in our country actually came from UltraTech alone. In the March quarter, they sold 41 million tons of cement. Now that is a 17% jump from the same time last year. And more importantly, this is not just because they bought new companies. Even their core business, which is the plants that they owned before they acquired these businesses, grew by 10%. And that basically means that demand is very clearly strong. And this growth volume translated to higher revenues as well. They had 22,788 crore rupees in revenue, which is 14% higher than what they had last year. And since they managed their costs well, their earnings also ended up growing. Their EBITDA, which is the operating profit that they make before subtracting taxes and interest, stood at 4,721 crore rupees, which is also up about 11%. Now, interestingly, even India Cements, which was loss-making at this time last year, turned a profit at the operating level in this March quarter. So basically, UltraTech has not just grown bigger, it has also become a lot more efficient. But the question then is, how did they exactly manage to grow profits so efficiently, especially in an industry where the margins are razor thin? The answer for them lies in how they controlled costs across three key areas, which is fuel, power, and freight. Let me start with fuel first. See, in order to make cement, limestones and other minerals are heated in giant ovens that are called kilns. Now, these kilns need to reach temperatures of around 1450 degrees Celsius, which by the way is hotter than molten lava. And it takes a lot of fuel obviously to keep them running. One of the main fuels used here is pet coke, which is a coal-like byproduct from oil refineries. Now, this quarter, UltraTech was able to buy pet coke at $122 per ton, which is 20% cheaper than what it was last year. So basically, that brought down the fuel bill significantly to begin with. But they did not even stop here. They increased their use of captive coal, which is the coal they have direct access to through their own mines or long-term contracts. And on top of that, they blended in alternative fuels like plastic waste. And when you combine all of this, they basically ended up reducing their overall fuel costs per unit of heat. So basically, for every ton of cement that they produced, they saved more on fuel than they ever did before. Next comes electricity. Now, cement plants need a huge amount of power to crush rocks, to rotate kilns, to run conveyor belts, and a lot more things. Now, buying all of this power from the electricity grid is obviously very expensive. So UltraTech began producing more of their own power. They built waste heat recovery systems which basically trap the hot air which is leaving the kilns and convert it into electricity. They also tapped into solar and wind energy from their very own plants. And this is so much so that today about 1/3 of UltraTech's electricity is self-generated, which is obviously far more cheaper than grid power. And because of that, their power bill fell 10% as compared to last year. The next factor here is freight. Now see, as you can imagine, cement is very heavy, but it is also relatively cheap. And that means transporting it over long distances starts to eat into your profits. So keeping transport distances short is very, very important for companies. UltraTech improved its logistic network and brought down the average distance of shipment travel from 400 kilometers to 384 kilometers. Now I know that may not seem like a very big drop to you at first, but the reality is that when you move millions of tons across the country, every single saved kilometer makes a huge difference. And that is because diesel usage drops, fewer trucks are needed, and obviously as a result of it, costs end up going down. And together, all of these efforts have helped them run their operations far more efficiently. They managed to save money on every ton of cement that they made and sold, and that is how they reached a healthy operating profit of 1,270 rupees per ton. Anyway, now let's shift our focus and talk about Adani Cement, which is new but a very fast-growing challenger in this exact space. Now, for your quick context, in case you missed it, the Adani Group bought Ambuja and ACC Cement back in 2022 when they had a combined capacity of 66 million tons. And since then, they have been acquiring more companies like Sanghi, Penna, and Orient, and they're also expanding existing plants. And because of all of that, today Adani Cement has crossed the 100 million ton mark. And that means in just about 3 years, they have become one of India's most serious players in cement. In the March quarter, Adani Cement sold 18.7 million tons, which is up 13% from last year. Their revenue went up to 9,889 crore rupees, which is also up by 11%. And their operating profit, which is their EBITDA, came at about 1,868 crore rupees, which again is about a 10 to 11% increase. But there is a catch here. Their net profit, which is their PAT, actually fell by 16% down to 1,282 crore rupees. The question is, how does that happen when their business is doing so well? Well, it turns out that there are two reasons. First is that the company scrapped some old kilns which were nearly 40 years old at one of their plants in Barchasa. Now, of course, that can be considered a good long-term move, but in the accounting terms, it means taking a one-time hit of about 200 crore rupees as an impairment change. Basically, Adani Cement had to write off the cost of these kilns. The second reason is that last year's numbers were boosted by a government subsidy of 826 crore rupees, which is a kind of a one-time support that did not repeat this time around. So basically, if you remove both of these special items, the core business is actually stronger now than it was the year before. And just like UltraTech Cement, Adani Cement has been working on costs as well. Their fuel costs fell 14%, which was helped again by cheaper pet coke and better access to captive coal, all thanks to Adani's broader trading and logistics network. Their freight costs also came down by 2%. Their average delivery distance shortened by about 15 kilometers, and more than half of their trucks now deliver directly from their factory to dealers with skips depots in between, which essentially saves both time and diesel. What's also interesting is that Adani Cement is investing into green energy. A brand new 300 megawatt wind solar park now supplies 26% of their electricity, and they have ambitious plans to take this up to 60% by as early as FY 2028. And I'll also tell you something interesting that Adani Cement is doing, which UltraTech Cement is not talking about as much. Adani is trying to make more money per bag by selling more premium cement. See, today 29% of Adani's retail sales are from premium brands, which is up from 24% last year. Now, these specialty cements fetch 200 to 300 rupees more per bag and also help them improve their margins without really having to sell more volume. One more important detail is that Adani Cement has zero net debt. In fact, it has 10,125 crore rupees of cash on its books, and that means that they can fund their future expansions from 100 million tons today to 140 million tons by FY 2028 without taking any fresh loans whatsoever. And that, of course, gives them a cleaner balance sheet and much more financial flexibility. But the problem is, rapid growth also brings in with it a lot of complexity. The thing is, Adani has grown largely by buying smaller cement companies, each with its own set of systems, suppliers, processes, and also people. Now, the problem is, integrating all of this smoothly is a huge challenge. The company says early signs are good and synergies are showing. But as with any large merger, the real test is whether costs continue to fall quarter after quarter. So if you zoom out, there is a broader trend to watch here. Both UltraTech Cement and Adani Cement are definitely expanding fast, and they are not the only ones doing so. More capacity is coming up across the industry, and India will soon be able to produce a lot more cement than we ever did before. And now with the top 5 players controlling around half of the market, the industry is becoming far more concentrated. Now, of course, this can be a bit of a double-edged sword because on one hand, large players with scale can operate a lot more efficiently, but on the other hand, too much capacity chasing the same demand could spark more aggressive competition. And that could mean price wars, tighter margins, and also pressure on profits, especially if demand does not grow as fast as expected. So while both of these cement companies have had a solid quarter and are also confident about the future, the real story might actually unfold over the next few years when we see how well all of this new capacity is absorbed by the market, how competition evolves, and who manages to stay efficient and profitable in a harder fought market. With that, let's move on to the second story. See, the World Bank recently released its April 2025 report on global commodity markets. Now, if you have been feeling like the world is always on the edge because of wars, extreme weather, energy shocks, food inflation, and whatnot, you're possibly not wrong and not even alone. Now, the thing with this World Bank report is that it does not really dismiss any of that, but for once, for a change, it actually offers something a little bit unusual, which is a bit of a calm moment. If I were to give you a one-line crux of this report, it says that global commodity prices, after swinging wildly for many years now, are finally expected to fall. But like I said, that's only the very basic crux of it. Let me slow down and talk to you about what really matters here. See, when we say commodity prices, what we're talking about is the cost of raw materials that sort of power the world, which is things like oil, coal, food grains, metals, fertilizers, and many more things. These are the basics that feed into everything else, which is the petrol in your car, the rice on your plate, the cement in your house, or even the copper in your wiring. Over the last few years, prices of these commodities has been jumping up and down like never before. Oil crashed to $20 per barrel during COVID, only to shoot back up to nearly $100. Cocoa became so expensive that chocolate makers started shrinking their bars. Metal prices have behaved like penny stocks, but according to the World Bank, all of this wild ride is now starting to slow down. They expect commodity prices to fall by about 12% this year and then by another 5% in the year 2026. Now, that might sort of sound like the world is finally returning to normal. But honestly, that would be a very wrong takeaway. The drop in prices is real, yes, but the world behind those numbers is still just as unstable, if not more. In fact, the real message is that we're not heading towards stability at all. We're actually entering a world of faster, sharper, and much more unpredictable commodity cycles. And countries like India, which depend heavily on imported commodities, will have to stay on high alert. Let me tell you something that the report says, which does not get talked about enough, which is that the cycle of commodity prices itself has changed. See, traditionally, commodity prices would move in long, sweeping cycles. A full ride from a boom to a bust would take around 8 years on an average. Now, that of course gave governments, businesses, and also farmers a lot of time to plan. You could basically look at long term trends and make reasonably sound decisions. But now, the whole cycle has been cut into half. Since 2020, the World Bank says that the average duration of a full commodity price cycle has dropped to less than 4 years. Prices shoot up faster than before, but when they crash, the recovery takes much longer. So basically, we're getting lesser time to plan and obviously more time to absorb the shocks. And this, of course, makes life difficult for almost everybody. Let's understand this with an example. Let's say a refinery decides to expand capacity because crude oil prices are high and it might finish the expansion just when prices crash. Another example is that a farmer might invest in high cost seeds during a price surge only to find selling prices collapse by the time of the harvest. And if you talk about governments, they have even lesser room over here to make decisions about subsidies, taxes, or long-term contracts. Basically, the world is changing faster than their policies can keep up. The question is, why is all of this happening? See, a big reason is now that the shocks are overlapping. First, we had the COVID-19 pandemic, which disrupted supply chains. Then came the Russia-Ukraine war, which sort of messed up with energy and food exports. And add to that more frequent and extreme weather events, rising protectionism, and green energy transition, all sort of happening together at the same time. So basically, even though prices are currently falling, we are not really seeing a return to calmness. In some sense, we are probably in the eye of the storm and the next disruption could be just around the corner for us. And that, ladies and gentlemen, is the big picture. Now, let me walk you through some of the key commodities to understand what's exactly going on here. Let's take crude oil, for example. Global oil prices are expected to fall sharply this year. Brent crude, which is the benchmark price, is forecast to average $64 per barrel in 2025, which is down from about $81 in 2024. Now, that is a huge drop. Why is this happening? Because supply is growing faster than demand. The world is expected to produce 1.2 million barrels per day more than before, while demand will only grow by about just 0.7 million barrels per day. Now, that is half the rate at which oil consumption was rising before the pandemic. And if you're wondering what the reasons for weaker demand are, they're pretty straightforward. Economic growth across the world is slowing down, and at the same time, more and more people and governments are shifting to electric vehicles and cleaner fuels. And for a country like ours in India, which imports over 80% of our crude oil, this is a bit of a blessing, to be honest. Every $10 drop in oil prices roughly saves us about 0.3% of our GDP in import costs. If oil prices stay where they are right now, India could save close to 2 lakh crore rupees on our import bill. But there's also a catch to this. The oil market is deeply political. There is tension in the Middle East, and if war breaks out or supply gets disrupted, prices could shoot back up to $80 or more. But on the flip side, if the global economy slows down even more than expected, prices could fall even further. So yes, while we are getting a break, it may not really last too long. Now let's talk about coal. See, globally, coal prices are also expected to fall. For instance, Australian coal, which is one of the most widely traded grades, is projected to drop by 27% this year and another 5% next year. But I'll tell you where things get interesting. See, India is not just a big importer of coal. We are actually the only major country where coal demand is still growing. China, for example, is slowing down its use of coal. Europe is cutting it out entirely. But India's electricity demand is booming and renewables still have not caught up in our country. So basically, even as global prices are falling, India will account for the entire net increase in global coal consumption until at least 2026. And that helps us for now, but it is definitely not a permanent solution. Over time, coal production around the world is declining, and if we do not reduce our reliance on imported coal very quickly, we'll face rising costs again once global supply tightens. But anyway, let's now move on and talk about food. And this is where things get a little bit messy. On one hand, the prices of some staples are easing out. There have been strong harvests of rice, wheat, and maize globally. India has also relaxed export restrictions on rice, which has improved supply. Plus, edible oil prices are dropping between 6 and 17%, which is obviously great news for India because we import more than half of what we consume. But on the other hand, fertilizer prices are up by 10% over the past year, and that is mainly because China has restricted phosphate exports. Also, many fertilizers come from countries like Russia and Belarus, where sanctions complicate trade still. But still, supply has broadly kept up with demand, which is why prices have not really spiked too badly. But there is still a big problem: coffee and chocolate. Now, these two are going through a very big crisis. Poor harvests in West Africa, fungal diseases, and hot weather in Brazil have triggered a supply shock. Cocoa prices have gone up nearly 70% year over year, and coffee prices, especially the high-end Arabica variety, are are up more than 50%. The World Bank expects the beverage price index to rise nearly 20% this year, even though other food prices stay relatively flat. And this is just the beginning, mind you. Over the long term, food prices are increasingly tied to the weather. A bad monsoon, unexpected droughts, or flood could sort of derail everything. In many ways, we are just one climate event away from just another price surge. Now let's talk about metals. See, industrial metals like copper, aluminum, lead, and nickel are seeing steady price declines. The World Bank expects the metals index to fall 10% this year and another about 3% in 2026. And that is largely because of a slowdown in China's property sector, which is one of the biggest consumers of construction metals. Iron ore, for example, is expected to fall by 13% in 2025. Nickel is an interesting case though. It is supposed to be a key material for electric vehicle batteries, but still its price has dropped nearly 35% over the last 2 years and is expected to fall a further 6%. Why, you may ask? Because Indonesia, which is backed up by Chinese investment, has rapidly increased supply here. They now control over 60% of global nickel production, and while that means cheaper materials for green industries, it also means that the entire world is vulnerable to just one country's policies. If, for example, Indonesia starts restricting exports or raising levies, prices could shoot back up very quickly. Another interesting thing here is that other metals are slowly starting to lose relevance here. Lead, for instance, was heavily used in batteries for petrol and diesel vehicles, but because electric vehicles are taking over slowly, demand for lead is slowly fading away. But that said, there is one metal that is breaking the trend here, which is gold. See, amidst all of this uncertainty, gold has hit record highs. As long as people feel that the world is unstable, they usually continue to put their money into gold, and that usually keeps the prices high. But that said, beyond individual commodities, the report also highlights something that is shaping all of these trends, which is trade barriers. See, over the last 3 years or so, restrictions on commodity exports have shot up to more than 10 times their pre-COVID average. Countries are increasingly banning or taxing exports of key materials to protect their own domestic needs. Now, these moves distort prices. For example, if China puts a tariff on American soybeans, American prices could fall even as prices everywhere else rise. Now, that makes global markets harder to predict and harder to also operate in. It also leads to severe volatility because prices in one region start moving independently from prices in another. Finally, the report also includes a stress test. It asks what happens if the global economy enters a mild recession. And the answer is pretty sharp as well. Commodity prices could fall by 25% in just 9 months. And that sounds good if you are an importer, but it would be devastating for commodity exporters who depend on these particular revenues. So if I were to summarize this, the report suggests that we are definitely in a moment of relief, but not of stability. Prices are falling, yes, but the cycles are shorter, the risks are higher, and the margins for error are much thinner. Trade walls are rising, weather patterns are more erratic, and geopolitical uncertainty hangs like a cloud over everything. Now, for our country, India, the current movement is fairly positive because there is falling oil and food prices, which means lower inflation, a smaller trade deficit, and more room to sort of breathe on the fiscal front. But that comfort, like I said, is very fragile. Well, that brings me to the end of the 2 stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, Indian Hotels Company Limited, which is the Tata Group's hospitality arm and parent of Taj Hotels, reported a 25% rise in consolidated net profit to 522.3 crore rupees for the January to March quarter of FY 2025 as compared to 417 crore rupees a year earlier. Second, India has proposed a zero tariff offer on steel, auto components and pharmaceuticals to the US, but only up to a specific import threshold beyond which normal duties would apply. This offer was made during trade negotiations in Washington as both countries aim to finalize a bilateral trade deal by this fall. The talks are part of efforts to reach agreements before the end of the 90-day pause on US President Donald Trump's retaliatory tariffs. Third and the final one for the day, India's overall automobile retail sales rose 2.95% in April 2025 to 22.8 lakh units compared to 22.2 lakh units in April 2024, according to the Federation of Automobile Dealers Association or FADA. Two-wheeler sales increased by 2.25% year-on-year to 16.8 lakh units, while passenger vehicle sales grew 1.55% to 3.4 lakh units. Well, that's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and I will see you tomorrow. Bye-bye. Disclaimer, this content is for informational purposes only. None of the stocks, brands or products mentioned are recommendations or endorsements.